Hello, everybody, and welcome to the Trading with Ashley show. We had a healthy pullback today on the NASDAQ, and I took full advantage of that. I purchased some skips, I purchased some leaps, I looked at some major companies and did the same for them. So in the community, we are looking forward to our red turning into green here in a couple of weeks as maybe we enter this Christmas rally and all the noise in the market settles down a bit. So I will have you know, we actually flirted with extreme fear today on the CNN Fear and Greed Index, and that's actually a really good time to deploy cash, as you have seen in a lot of my videos. Also, it's a really great time if we are going into big tech earnings in the next week or two. It's a great time to have a market pullback now. That really sets up the market for a rally if these earnings are strong. Now, everyone loves the thought of playing earnings, but you always hear, don't do it, it's too risky. And it can be really risky, especially if you are going to purchase a call or a put thinking you know if the market is going to go up or down. For one, you are overpaying in premium for that call or put. And two, you must not only choose the right direction, but that stock has to react fast in the right direction. And so if you are going to trade earnings, I want to teach you a safer way to trade earnings. You may want to bookmark this particular video and use it in the next earnings cycle as well, because the rules will stay the same to keep yourself safe. So the safest way to trade earnings is to be an option seller. And I'm going to take you through everything that you're going to need to be successful in this. I'm going to take you through how much premium typically moves based on elevated IV. I'm going to show you how to adjust IV on an option scanner so that you can use it to gauge how your trade will perform after the earnings event. I'm going to show you how to use the tools I use to try to make the best decision for your trade. We're going to look at the technicals on major stocks and what levels that you might want to put a stake in the ground that you're willing to buy if they drop to that level. I am going to also teach you how to calculate expected move after earnings, and that can be extremely helpful if you are going to want to try to play this volatility game in your favor. So this video is jam-packed with a lot of great information that will help make you a smarter trader. But before I get into all of that, I have to share with you something I am doing for all of you that are interested. I am going to offer free live trading this Saturday. There is a link below for you to sign up for that free trading. Now, I will not be sending out a recording. If you want to be a part of it, you must sign up and you must attend. And the subject matter, well, it's going to be really exciting. I am kicking off a $50,000 retirement challenge within my community. And if you want to be a part of that, I am going to help prepare you for the challenge. Now, you do not need to be in my community to attend this training. This training will give you a lot of great information that will help you if you want to try to grow your account. I'm going to basically take you through all the different ways that I trade and when I deploy each of these different trading styles. So I know you'll get a lot out of it. And then if you do decide to join my community, I have a special surprise for those of you that you can only get if you attend this webinar. All right, let's get into the details on everything earnings. I'm going to take you through some of the major players and when they are going to report earnings. And then I'm going to help you prepare yourself so that you can make the best decision if you decide to take the trade. Let's take a look at all the major companies that will be reporting in the coming days. Now, we just had Tesla today. Then we have Google to look forward to on the 29th. We have Microsoft, Meta on the 29th as well. We have Apple and Amazon on the 30th. Then we get to AMD on the 4th and then NVIDIA on the 19th. We also have Palantir and Robinhood and Sofi coming up. So there's a lot on the docket, and I am going to take you through some of the more popular ones, and we are going to look at levels of support so that you're prepared. Let's take a look at the IV and how it is adjusted based on earnings. Elevated IV can increase your premium anywhere from 20 to 50% pre-earnings. So that means more money in your pocket as an option seller. Now, if you're trying to determine the best possible time to take advantage of the elevated IV, keep in mind that it increases each day once we get to about 5 days out and its highest 24 hours prior to the event. An example would be if you had a stock that had an earnings date of Tuesday with a Friday expiration, still be really intense. But if you had a Thursday earnings report with Friday expiration, it's going to be even more. It's really dangerous, though, to use an expiration date that's that close to the earnings itself because there's just not a lot of time for the stock to bounce. And I want you to realize that on the vast majority of stocks that I trade, IV crush takes place immediately post earnings. So you will wake up the next morning, and if the stock went in your favor or stayed flat, you will see that automatically you are making money from the option that you sold just because of IV crush. But remember, there's no free lunch. If you are getting more premium, you are taking on more risk. And so will certain stocks rise or fall pre and post earnings? Well, again, it's impossible to tell, but if you look back over the last 4 earnings seasons, I put together some data for you so that you can look through this to see if it's typical for it to rise or fall pre and post earnings. This may help you as you're making your plans. When we are trading over earnings, we want to be as careful as possible because the volatility that enters earnings, it does help us if we're option sellers, but it also adds some unpredictability to something that would otherwise be a little bit more predictable. So here's how you keep yourself safe. You want to first check and ensure that the stock that you are trading over earnings is a profitable company. As most of you have seen when the market's been under pressure in the last couple of days, all of the companies that don't have a strong business model yet, meaning they don't have profitability yet, they do not fare as well. That's who gets sold off in lieu of buying more profitable companies that are more of a sure bet. So there's room for speculation in everyone's portfolio, but I would not trade a speculative stock over earnings. It's just too volatile. The next thing you want to do is identify a strong level of support that you would not mind owning the stock if, in fact, it dips down after earnings to that level of support. After all, the whole reason we sell puts on a stock, it's to gain ownership of the stock. And if a stock's going to go down after earnings, maybe you don't mind picking it up if it's the right level. Plus, you're being paid quite a bit of premium, so that insulates you a little at the beginning. The other thing, you want to calculate the expected move. I'm going to teach you how to do this. It's all driven off of the at-the-money price of the put and the at-the-money price at the call. I'm going to show you the calculation so that you don't have to spend a lot of money on services that will give you the expected move. I want you to be able to calculate it for yourself at any given time. And finally, you want to ensure you go far enough out after the earnings event so that you have more time for a stock to bounce if it dramatically pulls back after earnings. We look at levels of support to see where their buyers are, so you need a little bit of time. If a stock does dip after earnings, you need time for those buyers to step in and push it back up. So if you do all of these things and you use all of these tools, you can help stack the odds in your favor. Now I'm going to show you 3 very popular stocks that all of you like to trade and how to identify a great level of support if you are going to, let's say, sell a put. Here's one of the ones that's really popular, Robinhood. Now let's look right here at this 50-day moving average. It's right here at 122. There is a lot of support there. So if you want to make a trade and you truly want assignment, you might want to consider right here something around 122. If you want to be a little bit safer, come down right here to the 100-day moving average. It's a stronger level of support for a stock. If you're going to do that, you might want to set your sights on something around 105, 106 for Robinhood. Next, let's look at Sofi. It's another very popular one, and it has really run up quite a bit in the last couple of months. So you can see right now we are sitting on the 20-day moving average right there at 27. That might be a decent entry, but you have this 50-day moving average that's so close under it, you might want to consider looking at about the $26 level. You could also shoot for the bottom of the band. It looks like there's support there. I can see right here candle touches. But if you want to be even safer, then you might want to come right down here to the 100-day moving average and look for something around that 2250 mark. If you want to go really far out and be super conservative, well then maybe you consider this 200-day moving average right here around the $18 mark. Next, let's look at Pltr. As of today, here's what we're looking at. We're sitting right there on top of that 50-day moving average. This was why I went ahead and I purchased some skips today on Pltr because this is a great level that the stock likes to bounce from. So that's right here at about 172. The next level of support that I see for Pltr, it could come down here to right there, the 159, 160 level. You see that yellow line, that's the 100-day moving average. But if you look at candle touches, you do see a lot of support right here at about the 148, 149, you could call it 150 area. 150 is an important psychological area of well. If you want to be super conservative and go really far out in time, you can get some great premium, even if you go under this 128, which is the 200-day moving average. Now, I showed you how to do this on 3 popular stocks, but you can now apply the same formula on any of your favorite stocks. I'm looking at the 3-month chart on Yahoo Finance. The next thing I want to show you is how IV affects your stock and your premium, IV Crush. So what I like to do, I like to look at a stock. I like to put in my Google search for average IV for a Palantir. Once I do that, it usually pulls up something like Market Chameleon. Once you get to a website like Market Chameleon, this is the free version, you can come right down here to the 52-week average on the IV. You see right there, it's 63.5. And look, you can already tell it's elevated already. It's 68.4 in anticipation of earnings. Let's go see how that translates on an option calculator. So here we are at Palantir. I selected November the 21st, and I went with the 160 put. For that, I am going to receive $717 credit for the trade, which is really good because that's a lot of money. It's actually giving me quite the discount if I get assigned those shares at 160, and for my trouble, I'm getting another $717. That's great. So let's take a look at something right here. You see this implied volatility is currently high at 72. Well, I want you to anchor yourself. Let's look right here at the 31st of October. So if Palantir rises, let's assume it rises to 180. This same contract that you were paid $717 for, now it can be repurchased for less and you will keep $292. But let's see how this adjusts if I pull that volatility down to that 63.5 mark. Pulling it down to about, let's say, 64%. Let's go back to this. This is October the 31st. We're coming down here to the 180. Now look at this. You get to keep $392 once IV comes down to a normalized position after the earnings event. IV Crush has taken place. That's good for you as the option seller because that means you get to keep more in your pocket. Basically, the contract is less expensive to buy back. And finally, I'm going to teach you all about expected move. So first, we need to go to the option chain and let's look at the first date post earnings. So for Palantir, that's going to be 11/7. So when you get to the option chain, you can go ahead and come down to where all the action currently is. Now, I would do this right before you place the trade so that you have the most accurate information. But what you want to do is you want to take the at the money put side on premium, which is 1168, and you want to add to it the at the money call premium at the same strike, which is 1181. When you add those two together, that's 2349. Now what you want to do, you want to multiply that by 0.85. That represents one standard deviation, and that gives you 19.96. So basically what this is telling you is you can expect about a $20 swing up or down based on where all of the premium is lining up for Palantir. So the way you would configure that, you would look at 175, you would subtract 20 from it, that would get you down to potentially 155. Then if you want to look at the upward opportunity, 175, you would add 20 to it, and that would get you all the way up to 195. Now this is not a science, but you can use this to potentially gauge how high or low a stock may go after earnings. So how will this information help you? Well, let's assume you have 100 shares of Palantir and you want to sell a covered call. Well, you might consider if the expected move gets it up to 195, you would more than likely want to at least take advantage of that. So if you settle in on the 195 mark, then that's going to be pretty great for you because the delta is about 0.3, which means there is about a 30% chance it will end there. But also, you're going to be paid handsomely to give up your shares at 195. You're going to be paid $5.15 a share, and you're dealing with 100 shares, so that's $515 a contract. Now, if you want to hold on to your shares and be a little bit more conservative, then you'd want to overshoot the expected move. Maybe get to 200. That's an important psychological level, or even to 2 on 2. You're still going to get really great premium if you execute this sold covered call pre-earnings. Now, feel free to take a screenshot of this. Here's the expected move formula that I personally use. I take the at the money call premium, I add to it the at the money put premium, then you multiply it by that 0.85 for that one standard deviation, and you have your expected move. Okay, I hope all of you are pumped up and ready to trade after watching all of the different ways to stack the odds in our favor as option sellers. Remember, if you're with me, trading with Ashley, there is no trader left behind. Now, if you want to watch another video that I prepared specifically for you, you can watch that right here. And don't forget to sign up in the link below for the training that I'm going to be doing live free training this Saturday. See you then.